2025 was a watershed year for corporate America and beyond. Rising inflation, high interest rates, and shifting global trade dynamics contributed to a surge in bankruptcy filings. In the United States alone, more than 700 firms entered bankruptcy proceedings, many with billions in liabilities. But some of the year's most dramatic collapses came from companies once valued in the tens of billions. Today, we tell the story of the top 5 bankruptcies of 2025, selected based on their monetary impact, corporate valuation, and industry significance. Hi everyone, thanks for joining us today on Everything in a List. Today, we will be covering the top companies that went bankrupt in 2025. Please like and subscribe. Number 1. Northvolt, Europe's battery titan, falls under $5.8 billion debt. Our first story begins in Sweden with Northvolt AB, once Europe's most ambitious battery manufacturer. Founded in 2015 by former Tesla executives, Northvolt raised over $15 billion in funding to build gigafactories and break Asia's dominance in electric battery production. Despite the huge capital and lofty ambitions, mounting costs, production delays, and operational inefficiencies proved fatal. When it filed for Chapter 11 bankruptcy in the U.S. and later in Sweden, the company reported total debts of about $5.8 billion, with only minimal cash on hand. At its peak, Northvolt employed thousands and had contracts with major automakers. But by March 2025, its collapse became one of the largest industrial bankruptcies in recent European memory. Number 2. First Brands Group, auto parts empire with $10 to $50 billion liabilities. Next is First Brands Group, a once fast-growing auto parts conglomerate. Founded in 2013, the company acquired over 20 legacy brands, from filters to brake components, and appeared to be a sprawling success in the automotive aftermarket. But behind the expansion lay a massive debt load. When First Brands filed for Chapter 11 bankruptcy in September 2025, its liabilities were reported between roughly $10 billion and $50 billion, dwarfing its assets, which were estimated at $1 to $10 billion. Investigations later revealed financial irregularities and missing funds, raising concerns about opaque accounting and off-balance sheet financing. The company's collapse sent shockwaves through auto supply chains and debt markets. Number 3. Spirit Airlines, budget carrier with restructuring and $1 billion plus debt. Our third story takes us into the skies with Spirit Airlines, once the largest ultra-low-cost carrier in the U.S. Known for its bright yellow jets and rock-bottom fares, Spirit endured years of losses and failed merger attempts before formally seeking bankruptcy protection. Spirit's situation was complex. A previous restructuring cut about $795 million in debt, and bondholder financing added roughly $475 million to help operations. But the airline still faced a burdensome debt load in excess of $1 billion, which it could not sustain without drastic change. While Spirit aimed to rebrand and restructure, the bankruptcy highlighted the vulnerabilities of low-fare carriers in a volatile post-pandemic travel economy. Number 4. Nikola Corporation, from $30 billion valuation to $1 billion to $10 billion debt. At one time, Nikola Corporation represented a bold vision for hydrogen and electric trucking, briefly reaching a market valuation near $30 billion as investors poured money into its promise of zero-emission transport. But operational challenges, fraud allegations, leadership turnover, and a failure to scale production eroded confidence. When Nikola filed for bankruptcy in February 2025, it reported liabilities between $1 billion and $10 billion, while its assets ranged between $500 million and $1 billion. The company's rise and fall serve as a cautionary tale about the dangers of hype without sustainable production and revenue. Number 5. United Site Services, $2.4 billion debt in an unexpected sector. Our final story focuses on an unlikely bankruptcy, United Site Services, America's largest provider of portable sanitation and related event infrastructure. While not a flashy tech or retail brand, USS played a vital role at major venues, disaster response sites, and construction projects. Yet the company's aggressive expansion strategy was financed with about $2.4 billion in debt, which became unsustainable amid rising costs and a slowdown in construction activity. In late 2025, USS filed for bankruptcy protection, converting portions of its debt and restructuring under court supervision. The case underscores how even service businesses with steady demand can collapse under excessive leverage. These 5 bankruptcies, spanning batteries, auto parts, airlines, electric trucks, and sanitation services, illustrate a common theme. Massive debts and lofty valuations are no shield against harsh economic realities. Whether it was a $5.8 billion battery maker, a parts group with up to $50 billion in liabilities, or a budget airline with over $1 billion in restructuring debt, these companies faced the consequences of overreach, shifting markets, and rising costs. As we move forward, the lessons of 2025 will echo throughout boardrooms and balance sheets. Sustainability, prudent financing, and adaptability are key, no matter how big the valuation once was.